Well, if it isn't Mr. Junket himself, how you going?
How am I the junket? Your colleague's off.
Actually, yeah, Mitch.
Off to the US on a study tour.
Yeah, quote unquote study tour. Jamie's bloody, who knows what Jamie's up to. Everyone over there in the United States. So just a bit of a off-camera context. Jamie, Drew's business partner, and Mitch, head of funds at Rask, are both on the Inside Network's USA study tour at the moment, which is going to be amazing. They're going to Fenway Park. They're going to New York, Boston, MIT, Harvard, and then going over to Futureproof.
Futureproof.
Yeah. So it'll be a great trip for everyone involved. Commiserations to Drew and I. But
someone's got to hold down the fort, don't they?
Someone's got to pay the bills around here. So here we are. We're talking investing. It's the end of reporting season just about. So we're in the thick of it right now. Normally the last 2 weeks, last week of April, first week of September is like a brutal time on markets. What is your high frequency trading signals doing for you, Drew?
Head and shoulders. Pointing towards a correction in the latter half of the year.
Okay.
So I'd be very nervous. Yep. I thought that was a good question as well.
What?
Are
you being serious? I thought you were joking.
Surely we're due a correction.
Are you saying that just because? Wait a second.
The market is pumping.
No, wait for this, people. For anyone that's watching, you'll see this. I've got my clickety clacks here.
Oh, did you do an article about a correction? Am I Chuck crumbing you
again? Look behind here. Dizzy Rascals, 8.24%. Everything portfolio up 11.85%.
A great result.
But this is the best one, aka me and Monique, 12.4%. So for those of you that are tuning in for the first time, Drew and I had a bet at the beginning of the year against the community, $10,000 portfolio challenge, fake portfolios, just a bit of a laugh. And
buys lunch.
I've been behind the whole year, and look at it now. Gus up 7.5%. Bring that leverage, baby.
Where did it come from? Is this equally weighted too, or is this according to your weighting as well?
No, it's equally weighted. But we actually have run into a bit of an administrative hiccup because one of my companies is about to be taken over, which we'll talk about today, RPMGlobal.
But it won't clear, I'm guessing, for 3 months.
Yeah, but then what do I do with the funds, How do I redeploy? Because the rule was you had to put 10,000 fake Navexa dollars into the portfolio and hold it to the end of the year, no exceptions.
Is the deal done yet, though?
No, it's not even announced. At the time of recording,
exactly.
It's only in a trading halt because I don't actually know what's happening.
So don't count your chickens or go the early crow until the deal's done. If I've learned anything in my career, particularly takeover offers.
Governor.
But it is, is it Caterpillar that's buying it?
Yeah, so the rumor is Caterpillar is buying RPMGlobal.
Yeah.
But if you look at the share price chart, I'll bring it up here on Market Index for a sec. Look at that.
Does this continue the story of like last week, where I was talking about smaller companies not growing into mega caps anymore, and this is one of the reasons why.
Yeah, they just get bought out. Yeah. Just like Altium 2 years ago. So $3.20 went up to $3.90 yesterday because of the results. So RPMGlobal is the software company. We originally recommended it at Rask at 59 cents. I'm very happy for our long-term holders. Actually, just had someone reach out on Twitter and say, what did he say? He said, great pick, has been a mainstay in my portfolio from when I was a Rask member. That's from Scott. Thanks, Scott.
It hasn't been a smooth journey either. Look at that chart. There's a bit of zigzagging there too.
Oh, yeah. It's been
generally positive.
Yeah, generally positive. RPMGlobal is a software company for mining services. And so it's done really well. So if you're not watching, it's gone from, say, 2018, it was 50 cents and now it's up, nearly $4. And by the time we find out this takeover offer, I dare say it'll be $4. But
is this like GPS and all that sort of technology?
This is just pure software for mining planning. So planning a mine for maintenance and things like that. Like
why does Caterpillar want it?
Because they do all the mining maintenance software. So for example, if you're driving around a mine site, it will use GPS and those types of things, but it will calculate haulage. It will figure out the most efficient path for the trucks and the automated trucks or the human-driven trucks and maintenance and repairs and that sort of stuff. It does all that and it integrates with the mine site itself and all the operations day to day. They do fantastic planning as well. They're not quite like Imdex, which is the other big one. Imdex does more, my understanding is Imdex does more of like sensory monitoring and mine visualization planning. They do that too, but not to the extent of them. So absolutely wonderful business. But it was 2012, 2013 when Richard Matthews, who previously is a he ran a software business, Drew, for ERP, like ERP systems, kind of like
enterprise.
Enterprise. And then he saw the opportunity in mining, and he bought into RPM shares, and then he became the CEO and took over the business and transformed it from consulting into technology. And look at that, from what he would have bought his shares for about 40 cents. Probably got a few along the way as well. He's got a little early retirement coming up, although he probably had that from the last one.
Yeah, fantastic little story there.
Yeah.
Let's just
got 8 million
hope
shares.
the share price doesn't increase any further from where it is.
Let's hope it goes up another 30%, because that's probably what I'll need to win this challenge before the end of the year, because the bull market is raging on, Drew.
It is. And I mean, not for every company. I think as you've covered and you'll cover next week on the earnings kind of wrap, that it has been a tough environment for quite a few companies. But by and large, I think I was looking at the numbers, in the ASX and the S&P 500 are both already up 9-10% so far this financial year.
Yeah.
So in 8 short months, if you can call it 8 short months, which is always, anytime you're looking at double-digit returns. I found something quite interesting listening to our friends. I know you've quoted them here as well. There was a Fidelity survey that came out. So they were surveying US investors with more than $25,000 invested. I thought this was quite interesting, because this comes up all the time, which is that every time the market's fallen in the last 5 years, 10 years, it's bounced back quicker and quicker and quicker. Your example, when you bought on Liberation Day, Tariff Day.
Tariff Day.
Say liberal Tariff Day.
Well, basically was.
But it bounced back within the session almost. Like it closed almost higher at a gain after losing something like 10%. But they surveyed investors with less than 11 years experience or fewer than 5 and more than 11 years experience. And those with fewer than 5 years experience, so have only invested since the pandemic, were 56% of them were confident that their returns next year were going to be better than this year. And when it came to seasoned investors, so those with over 11 years experience, only 34% of them expected their returns to be better next year. And I was like, well, this is interesting. Is this because they've seen corrections before? If you've been around for 11 years, you've seen real market corrections where it goes in 10, 20, 30, if it's long enough, 40% back in the GFC. Is there a hint of recency bias, or are the younger or the new investors more young, and willing to take more risk, or overly optimistic? It's interesting whether there's a generation gap or...
I think the decade that you're born in defines how you see the financial world, so in a big way. But that said, there's also more financial literacy these days. Younger people just kind of have to do something with their money. But I wouldn't just characterize it as younger people. Maybe if you go anyone under the age of 60 that is an accumulator will see a downturn as an opportunity. It's always the way it should be, is sell-off equals opportunity. But it is a self-fulfilling prophecy, isn't it, Drew? Because if the last one bounced back so quick and the one before that bounced back quick, then the third one should bounce back pretty quick. I think it was Ben Graham wrote about this in the 1920s when he said that investors are incorrigible. All they need is for something to happen 3 times and they believe it's the truth. And so he was referring to behavioral finance in the 1920s, and he said, effectively, if you see something happen 3 times, it's going to happen forever. That's what people think. But as we know, it's not true. And it kind of relates to this point. It's a good segue in here, which you've brought up. I'm just going to bring this up for people that are watching, but if you're listening, I'll walk you through it. So Ben Carlson from Ritholtz Wealth Management put out a tweet, just a real simple tweet yesterday it was at the time of recording. He posted the NASDAQ 100 annual returns. Now, he's a US investor, so he'll be quoting returns in US dollars. So this is not the same as like NDQ or something.
These guys are the ones that own part of Futureproof.
Yes. So NASDAQ 100 returns from 2000 to 2012, negative 2.3%. So if you'd bought in 2000, obviously it was the .com boom.
.com, yeah.
And then 2012 is when the kind of the run-up post-GFC was. So negative 2.3%. If you took the next 12 years, it was positive 20%. So just like 12 years, the first 12 years was negative 2.3, the next 12 years was 20% per annum. And since the year 2000 until 2025, it's 8%. There's a bit of cherry picking going on here with the actual dates because of peaks and troughs. But imagine if you were a NASDAQ investor and your first experience was just on the back end of like the .com boom, or even today, and you think we don't know what the future holds. Your return for the next 12 years could be negative 2%.
Or worse.
Worse. Yeah. People don't think about this, but it could be, right? It's not just like
if you changed it to 2001, it would have been significantly worse, I'm guessing.
Yeah. So this stuff happens, Drew.
And then I was looking at the numbers, so the financial year returns for the last 5 years, and it tells you exactly what's here as well. 17 before, 24.1, 23.5, minus 2.4, 29.1. Like there's 20% returns in the last 5 years for the US shares. And Australia, it's 13.2, 12.5, 14.8, minus 7.4, 30.2. In the last 5, like it's all double-digit returns, which people have come to expect, but I think it's important. And I'm not saying the market's going to crash. Crashes happen all the time. But I think it's difficult to expect these types of long-term returns to continue to occur over the long term. Not saying that this decade's going to be negative or positive. I'm not better placed than anyone else to try and predict what that's going to be. But I think it means, as we talk about finding resilience, finding blending strategies and not relying on just one thing or the other when we're investing.
Yeah. The thing is, those numbers that you quoted for the US, they're even better for Australian investors because the Australian dollar has fallen through that time. So people are thinking, well, this is as good as it gets. Like it's going to just keep doing this. Worst years for the S&P 500 since the 90s, fell 37% in 2008. Fell 22% in 2002, fell 18% in 2022. So you get some bad years. And I think people are over-indexing with their recency bias to what's happened and just assuming, extrapolating that off into the future, which has obvious risks. In other news, the dome, credit to where the dome is due, as they say.
It's hard to deliver.
No, but Luke promptly reminded me that in recent times on the RAS podcast, he talked about SiteMinder, which popped like 30%, Australian Finance Group, YFG, which is up, I don't know, a lot, XRF, which is up a lot, RPMGlobal, which is up a lot. So Ben's done really well.
Ben, well done, Ben.
Well done, Ben. And today's episode is brought to you by Ticker, by the way, the Ticker Terminal, TIKR. Get your Ticker terminals sorted. Ticker solves everything in your investing life. Well, not quite, but it goes close. But yeah, I've done some analysis on Ticker recently. Actually, I'll share that with people. Some of it's already on YouTube, but I've been starting to do some episodes, such as the episode this week on Warren Buffett. You know, we didn't even...
He's on a hot streak, Luke, isn't he?
He is, yeah. He's got some good performance fees as well. You know, which we did talk about.
You called him out on that too, didn't you? Yeah. What's the high watermark?
Yeah, that's it.
Yeah.
I think he does have one though, so it's pretty good.
He does, but it's on. Yeah, we know.
But I just love his inversion. Like, it's like, yeah, I'm here to make you money.
That's it. Yeah. You want more money? Yeah. I'm going for more money.
Which is what you want from an active fund.
He's clearly in the 54% when we're looking at this. My returns are going to be better next year, every year. Even if I got 1,000% this year, it's going to be better next year.
You need that. We didn't, this, I can't believe we didn't talk about this news on the podcast before, Drew, but Warren Buffett's, for people that don't know, Warren Buffett's stepping back as CEO of Berkshire Hathaway.
When did he announce that? Did I miss that?
Yeah, a while ago. And we didn't even talk about it on the podcast.
Oh, we didn't, yeah.
And he said he's still going to go into the office, but he's stepping back.
Leaving his gigantic compound in.
Yeah. Sold some shares of Apple recently, still has about 280 million. Bought some more shares of not Bank of America, something like that. But anyway, I can bring it up in the Ticker terminal in just a sec. But in other news, Trav from Money of Mine podcast, so shout out to Trav. I went onto Twitter. I don't know if you've seen this, Drew. Do you get on Twitter much?
He still likes to rant. Not really.
No, good.
You haven't got me on there again, have you?
No.
Bit of everything, or?
So I went on Twitter the other day just as a random, I don't go on it much these days. I spend more time in the community, the RAS community, that is. I said, WiseTech will be an ASX 10 company within 10 years. That would mean a $58 billion market cap at today's prices, right? Because WiseTech got sold down, Disclosure owns shares, huge endowment bias here, but I think WiseTech is one of the better companies on the ASX, right?
Better businesses, yeah.
But then old mate Trav from Money of Mine tweeted me, and he said, I'll take unders on this at even odds. So now him and I have a $10,000 bet.
You love it.
So if
not a $10,000, you're going to pay him $10,000
yes,
if it doesn't get there.
Yes.
But then you're going to have less money.
but if it does get there, then he pays me $10,000.
Yeah.
I think it's a pretty
What's the time frame on this?
10 years.
10. Oh God.
Yeah, he messaged me privately and he's like, oh God, I think I did myself on this one.
Franking credits will be gone by then.
But WiseTech, to get to ASX 10 needs a $58 billion market cap. But if we jump back into ticker,
are you doing a modelling and what?
Yeah, let me just share this. So if WiseTech's here at 21 million US dollars here in the ticker terminal, it's grown its earnings per share at 38% over the past 5 years. So yes, it's on 130 times PE ratio, but if it can keep growing its earnings so fast, then it's not just going to double between here and 10 years. It could 3 or 4x. Meanwhile, the companies that are above it in market cap, let's just have a quick look at this.
Aren't you worried about the law of large numbers?
Yeah, of course it's not going to grow at that such high percentages.
37% forever, yeah.
But it will, I would imagine, its revenue is still growing at like 20% per annum at least. And I think it continue to do that because it's in software for shipping. And the more people ship, the more people will pay at them.
They couldn't get more wrong from a governance, it seems to be a governance perspective. And the companies, it hasn't stopped the growth of the company. The software,
I mean, he's got
nothing to see here.
Yeah. So if you look at the companies above WiseTech, you've got REA Group, which is barely above it. Woolworths, which got punished this week. We'll come back to that. Sigma / Chemist Warehouse. Brambles, which is a good business, but it's
big sell-off in Sigma shares.
Aristocrat, which sells pokie machines to vulnerable people. Transurban, which sells toll roads to the Australian government.
Are you trying to reduce the negative sentiment so people sell these companies?
Woodside, which sponsors Fremantle. Telstra Group, which does it's your mates, and Fortescue, they're all under $40 billion. So they're all within 20% share price movement of WiseTech. Remember,
so if they all shrink, WiseTech can go top 10.
I think, or they just can stand still over the next few years, which they're probably going to do anyway. And WiseTech will just dance on past them, and I'll be $10,000 richer. So yeah,
and probably 10 times that. And what's in your WiseTech holding?
Well, yeah, I'll just put that into my WiseTech and make even more money.
Yeah.
So hopefully we'll catch up with Trav soon and have a bit of a discourse.
So would you be buying now?
Yeah, probably.
Yeah.
But it's a small position, so yeah. But that's my news, Drew. That's what I got for you this week.
Oh, well, there's a bit happening in markets too. I think you alluded to it. Well, Woolies and Wesfarmers both reported this week, which kind of big holdings within big ETFs, but also big holdings within a lot of retiree and general share portfolios. I think there were some kind of interesting trends there. Did you take a look at this one?
Yeah, I mean, Woolies... Yeah,
Woolies I think they dropped 10% in a couple of days.
Yeah, then there's a heap of companies that have been punished recently. So sorry, go on.
It feels like it happens to Woolies every 10 years or so. Like you can remember 10 years, it must have been 10 years ago where Coles was owned by Wesfarmers. It was running Woolworths off their feet. They didn't want to be in a Woolies store. And then that pivoted. Woolies got better. The price got better. The service everything got better. And now it seems to be pivoting the other way. But it's not like it's that bad. You're just not seeing growth. And I think there's more attractive parts of the market for people. That's where people are looking at the moment. There was a group sales were only up 2%. Underlying earnings fell 15%. And the dividend was cut pretty significantly to 40, so down 20% to 45 cents per share. And that's probably one of those reminders of dividend investing where, you talked about the decade of that you were born determines your approach, a view on investing. We were born in the decade of franking credits. So maybe we're just inherently dividend focused because of when we were born. But it does seem like this is a kind of reminder that even slow growing, what are supposed to be high quality companies can cut dividends and do it aggressively when they need to reinvest in themselves. And one of those issues of not reinvesting in yourself enough, which is the opposite of what something like WiseTech does. Yeah, so I'm talking about this in this weekend's email actually. Sunday morning email, everyone. You can get it on the Rask websites. Preempted. Yeah, it's all right. But if we look here, this is my point to Trav on X, which was there is proof here that I did say it. Was that if you look at the ASX 20,
or later, share prices follow earnings, right? Not straight away. The data says it takes 5 years for the fundamentals of a business to drive long-term performance, like statistically relevant, not just the plus or minus in the PE ratio or something like that. Like the valuation fluctuates through time, but through things like sentiment or macro news. But over time, what drives a share price is fundamental performance of a business. And so if we look at the list of these companies again, so WiseTech's 2 spots behind Woolies, right? But if you look at normalized earnings per share over the past 5 years, Woolies has gone backwards 2% per annum.
Yeah.
That's what I mean by WiseTech. Yeah, it's at a really rich valuation, but even if the valuation just holds or even falls a little bit, it won't take long for WiseTech to pass Woolies just simply because it's more profitable. Like it's growing much faster. So
it's kind of like why Macquarie and Wesfarmers have been on the way up.
Exactly, yeah.
And the mining companies have been on the way down.
Yeah, exactly. So I remember when Wesfarmers sold, Wesfarmers now a top 10 company. It's growing like compounding earnings at 5% per annum, which is good for a big industrial business that also has sold Coles. So I remember when Wesfarmers sold Coles, its stake in Coles, I was like, oh, it's probably not a great idea. What's left inside Wesfarmers? But they went and bought like some lithium stuff. They've obviously got Bunnings. It's still powering ahead. They've invested more in industrials. So it's a really good diversified business. And yeah, Woolies just hasn't done that. So that's one of the big ones. I guess one of the businesses that always surprises me is actually Brambles. Oh, that's such a wonderful business.
Shep.
Yeah, sells the pallets.
Half the people don't know that it owns pallets.
Yeah, it's what it does.
Like, it should just be called Shep, surely.
Yeah, and it
global logistics.
The thing about it too is that it's actually a huge play on renewable. Kind of like not renewables. On like reduction of waste, and it's really good for carbon emissions and that because you can actually the pallets are made out of timber. And then they get recycled and used somewhere else. So really, really sustainable type business model, which is really cool too. But there were some other businesses that got sold down this week. I'm pretty sure AGL Energy got absolutely punished. Sonic Healthcare got whacked. Amcor got whacked.
Ramsay Healthcare, I believe.
Ramsay Healthcare. Well. Like all of these businesses that are kind of debt laden and just geared up and pretty mediocre businesses these days, like in terms of their the quality of their earnings and their ability to compound. Like
healthcare's been shocking, and that's the only detractor in your portfolio as well, isn't it?
Oh, how dare you?
I think you own it. It's just incredibly tough. So, like this is the environment where people are turning to defensive quality earnings, but they haven't proven to be as defensive as they usually were. We recently exited Ramsay. Or recommended, like we held Ramsay for a while, saw great opportunity. You can sell the story, aging demographic, private hospitals, public sector under pressure, all these sort of things. But the company itself is struggling. The cost of inputs has gone up. The money being spent by the government has gone up, and less. And it's not even. I think the trend will still be there longer term, but the ability for this thing to recover is getting longer and longer. And that's one of the. It's the same in Sonic Healthcare. So similar in CSL, where these great, strong revenue and earnings growth is just starting to dissipate. Yeah. And they're getting punished very quickly.
Yeah, definitely.
Even when profit goes up.
It's one of those things, isn't it? I didn't realize you were going to call me out for my healthcare play.
I think I actually let you into that because I usually say sector for this year is healthcare. And it would make sense. I reckon if you said global healthcare, probably would have worked, but I think you bought the local healthcare, which means just getting global, CSL.
Got global.
And did you buy ResMed too?
Yeah, we've got ResMed.
As a global healthcare, yeah.
The one that I've also got is Wesfarmers. This is the thing that keeps shocking me in the fake news portfolios.
It's beautiful, isn't it?
Up 30% for the year. I just see that and I'm like, that's a lot of sausages.
The result was pretty good. Did you see the result?
From Wesfarmers?
The share price is almost $92, which is, and they were saying over the last 10 years since Cheney became the chairman, it's tripled from $30 to $92. Net profit up 14%. Where else are we? Kmart doing exceptionally well. Everyone loves the Anko brand. Who was in Vic Gardens going to the movies last night. Kmart open pretty much 24 hours there. Yeah. It's always busy. But Kmart holding up. They sold their industrial gas business for $770 million. They've increased their dividend by 4%, but also paying a special dividend for the sale of that business. And yeah, their lithium mine. Bunnings might be slowing down. 3.3% sales growth, but that's on the size of that, almost $20 billion in revenue.
Yeah.
That's incredibly solid growth, and your earnings are coming from other areas.
You just need all the bloody pet owners to get there and start buying their dog food. But
everyone was a bit anti-Victoria this reporting season apparently too, but we don't want to touch on that.
Well, that's fair enough.
Work from home policies and increasing thefts and that sort of thing.
Well, it's not Detroit, let's be honest, but
yeah.
It's there's a bit of debt in the system, and there's a Labor government, so they've been doing a great job of stuffing it up. So, just being real with everyone. So,
just trying to sidestep that myself. Qantas had a record profit.
Qantas up at $12 a share. Tell us more about this.
Let's get the attention back onto Qantas. So after getting hit with a $90 million fine for sacking all those people during the pandemic, of apparently I think something like half of that went to the union to be distributed, because I think they're the ones who funded and pushed the case forward. But the new CEO took attention away from that by reporting massive profit. So like a 50% jump in earnings at Jetstar, which I was lucky enough to fly on to Cove.
Blessed be the fruit tree.
Yep.
There you go.
Yep. You got to love Jetstar.
How did you find that, like coming down from Qantas to Jetstar?
I rarely fly on. I'm usually Virgin, to be honest.
Yeah.
But it wasn't, it was completely fine. I mean, food lacking a little bit, but I don't think any plane food is exceptional. And for the price, pretty solid. It's just getting used to weighing your bag every time you get to the airport.
I actually saw some Ryanair in the UK. The CEO has again increased the bonus for every time one of the flight attendants catches a traveller with a bag that's heavier. So they get a bonus every time they ping someone. Yeah. And to be honest, I reckon this is my unsolicited business advice to whoever's running Virgin at the moment, is actually like enforce that rule, because
do it. Yeah, let's do it.
Like the amount of people that have like, oh, this is just my
you
third
carry
bag.
3 bags in there.
You're like, no, because then you end up sitting like this is so crammed. I was we were coming back from Sydney on Wednesday, and we had this amazing bloke in the cabin crew, and he was like, everyone was sandwiched in the plane trying to find their seat, and he goes, and this is he was unhinged. He was like, these fucking Sydney to Melbourne flights, they're the bloody worst. I can't wait to get you all off this plane. And then he's like, he's grabbing people's jackets out of the overhead bins, and he's like, whose is this? This should not be here. And then throws it down at them, and he's just like going for it. And I thought, good on him, you know?
More of that.
Give it to us.
Had a bad day, it's a pretty depressing flight, though, that one.
It's the busiest route in the world. So
and most profitable.
Yeah, so, hectic. But Qantas has gone from, $1.19 in 2014 to $12 a share. Buy, hold, sell.
Sell.
Okay.
Not just because of Jetstar, but they must have had some cash put away for the potential legal result, or just been building up more and more and more. So they're paying out, and I guess is the way they game the dividend yield system too, which is that they pay a final dividend, which was an improvement, but they're also paying out just a special dividend of almost 10 cents a share, so $400 million to be paid out. But by paying it as a special dividend, it doesn't. People aren't expecting it next year. That makes sense. Whereas if you increase your 16.5 to 25, people are going to expect 25 next year. So they're kind of releasing themselves of that and returning a bit of capital. Because I wasn't aware of them selling any businesses, or maybe Jetstar Asia. Maybe was that sold? But I thought, a massive result. If you're looking at flying anywhere, if you're looking to go to Europe or Asia or anywhere at the moment, it's incredibly expensive. So. No wonder they're doing well.
Yeah, well, they've got basically a monopoly on everything. So it's interesting.
Domino's tanked.
Just before we get to the pizza, so I just asked you buy, hold, sell. You said sell. Long-term debt at Qantas has gone from 4.4 billion, 4.8 billion, 6 billion. Does debt go higher from here, Drew?
I wouldn't think so. I feel like they've got themselves in trouble doing this before, haven't they? Where debt got too high, and I assume that debt the debt has to include all the airline, like they don't own their planes, they lease their planes in a lot of cases. I can't see it going much higher from here.
I will disagree. I actually think it will go higher, because when
we just paid out $400 million in cash, why wouldn't you use that to reduce your debt?
I remember when because you got to keep the punters happy, so you can do a big capital raising in the future.
You reckon they're going to go buy a whole heap of Airbus A380s or the Boeing Dreamliners?
I remember when we were talking to Joe Aston on the show. And he was like, does anyone, he's basically, I'll paraphrase what he was saying. He's like, Doesn't anyone check to see the age of these planes?
Well, there was duct tape holding something onto the plane that we were looking at out the window. So someone brought it up. I'm like, yeah, but duct tape fixes everything. It's fine.
Yeah, makes sense. Yeah, I don't know. I feel like cash flow is very good. Virgin's obviously gone broke, then came back. So
I guess you've got to an inherent government guarantee as Qantas, don't you? Like you can take on as much debt as you want. The government's going to bail you out.
It's all regulatory capture thing. Like there's no way that anyone can compete because it's just regulation. Like even trying to get Qatar to take that 25% stake in Virgin, it basically took like public outcry. It took it like the Prime Minister getting threatened basically by everyone in the country to be like, stop letting your son go to the chairman's lounge kind of thing, before they actually did something about it. So now with Qatar owning 25% of Virgin, that is very interesting, particularly for a Virgin flyer myself with points. It actually makes it so much easier for international travel. So yeah, there's that. What else is making news? What are that? Because we've got time for a couple more companies if you've got some news for us.
One thing we were talking about dividend yields last week. I thought it was worth highlighting. There's a lot of income products, but it's worth highlighting distribution yield versus dividend yield.
Yeah, good point.
Yeah. So distribution yield is the level of distributions you've received from an ETF or a managed fund. And I find that interesting because if you have like an option strategy or if you have even a S&P 500, so it's pouring, it sounds like it's pouring rain here, an S&P 500 ETF, if that had a lot of turnover, you're going to get a big distribution, but it's not coming from dividends. Whereas a dividend yield would be the dividends that ETF has received from the stocks that are actually paying dividends. So I think people always get confused about that because dividends are going to be stickier than distributions.
Yeah, good.
And always, I think, important to keep that in mind. And then we had the big boy reporting, which I missed, and it didn't look like it changed the share price all that much.
Oh, you mean that little guy over in the United States? Yeah. Hey, just quickly, we'll get to the big boy in just a sec because I do want to bring that up and how it's not helping you. But a good example of this is we own the Lakehouse Global Growth Fund Active ETF, and I'm here on the Market Index website, and you can see
a lake house as well as a beach house and a boat.
Do you?
No.
So dividend yield, 11% is what it says. So it says it's got 11% dividend yield. This is a high growth tech predominantly fund. There's no way that it has 11% dividend yield. And that's because all the brokerage accounts, all the data providers, they all just report distributions as like gargantuan dividends. When they're not. They're not dividends. So you got to be really careful if you're hunting for ETFs and funds and that sort of stuff, doing that sort of a thing. But yes, Drew, there was some news out, and I'll just bring this up for people because I was very happy about this. Let's go back to rasmedia.com.au/portfolio. There was a company that reported yesterday, and you were like, "We'll just wait for this report." And the company is called.
Oh wait, I've caught up. Have I caught up more?
Yeah, in the time.
I think I have.
You have. You're only 30 basis points.
We're live. I reckon we could be watching the last trading day of the year, and we'll record live as the market closes. Oh, but we're going to have to do it in the morning because it's US time.
11.91%.
Yeah,
is what you're at, and I'm 12.28%. Yeah, so your big boy, aka where am I? Nvidia reported last night, but the share price hasn't really moved that much. What happened?
It's a bit surprising. I mean, it was a pretty solid report, but as is the case with such fast-growing companies, if you don't meet broker expectations, and broker expectations tend to be pretty aggressive, then you either get smashed or you just do nothing. And I think, like, as much as I wanted it for the portfolio, a company the size of NVIDIA that's had a run like NVIDIA doing nothing when they report is pretty positive.
Yeah.
Like, it hasn't surprised to the upside. Hasn't surprised. I mean, you prefer it to surprise the upside, but it hasn't surprised to the downside. But the numbers were massive again. So as they talk about I think the original business, I think the data center business alone, so just the data center chips was at $41 billion in US dollars billion in revenue, is bigger than every other chip company in the world. Just the data center part of NVIDIA.
Wow.
The automotive part also growing, but the growth rates have decelerated. And this is the problem we were talking about, I think, what we were looking at last week, Pro Medicus, where you have such massive growth rates, but as your revenue gets bigger, can you keep those growth rates up? So it was 101% growth rate, so it was doubling every year, dropped to 94% on revenue and dropped from 78 to 69% in earnings growth to the comparable period last year. Even quarterly growth. I mean, you just still look at these numbers. Have dropped. Quarterly growth rates dropped from 69% to 59%. It's like, yeah, I still take 70%, 59% earnings growth on a quarterly basis. Like, what are we complaining about here? But obviously, it has to grow to justify the valuation, apparently.
Yeah.
But revenue is still growing, and there's a lot of talk that the AI chip demand is not going. Like, people are underappreciating what this is going to be and the ability for NVIDIA to keep up with it. And they seem to be being able to keep up with it quite well in the last 2-3 years.
So buy, hold, sell.
Buy.
Okay.
Bold one.
It is a bold one.
On what? Yeah, on what time frame?
Yeah, 5 year.
5 year? Yeah, I think you'd still buy on 5 year. Maybe if you're talking like 3 months.
Okay.
Like, you'd be wary of buying right now, straight after an earnings result.
Interesting theory.
But who's buying for 3 months?
Well, that's it. People that trade options. So futures trading in Australia hit record levels in April, says Drew. Similar story in the US. Why?
How do you feel about options?
Oh, I don't feel much for them. But
Yeah.
no, I think that
So you're introducing leverage.
yes, but for the average punter on the street, I think that you'd never trade Aussie options.
Yeah.
You would maybe consider US options for entry, exit, like for positioning and hedging. But I think that's a bit of a, like, I think if I've been very blessed that I've been around a lot of hedge funds and a lot of trading firms prior to starting Rask. And I got to see the pros, like the best of the best derivative traders. And a lot of them that run these funds would just basically conclude after the end of their career, probably not worth it.
You can't win.
Yeah.
You can't win against them either.
Because a lot of the time when you trade options or you trade futures, there's often a drag on portfolio performance. So you often have the cost of the entry exit, but you also have a cash drag from holding options, a cost drag, a premium drag. So you end up, my understanding, Drew, and you might be able to correct me on this, but my understanding is that in most funds that add options to their strategy, they probably ultimately underperform by 2 to 3% per annum, simply because of the cost of the protections or whatever they're trying to trade. So over the full cycle, they don't work. But in certain market environments, like they might, because they might provide some protection or some upside. But that's my kind of summary is, on average, over a 10-year period, I'd expect them to underperform.
It seems to be becoming a game in the US though. Like like retail investors getting into options, like basically betting on share prices continue to increase, or in most cases. Yeah. Or less so for hedging portfolios.
Yeah, I'd say that this is a good if you're a second year investor, so you've just graduated from year one and you're like, oh, I remember reading something online one year. This was back when I was starting investing a long time ago. And I saw a comment in a forum because I was trying to learn about options and warrants and all this type of mumbo jumbo. And some guy said, yeah, buying shares is like watching the grass grow. I prefer to trade options. I'm like, yes, get me some of that. And it obviously was a bad idea. So I think it's pretty seductive to people to increase complexity as their journey into investing goes on. And this is why we talk about the humility curve a lot, right? Like, I think I can bring this up for people that are watching, but the humility curve is basically, it tracks your kind of the complexity of your investing to, I guess, the returns that you ultimately get and the experience that you feel. So if you look here, this is my humility curve, Drew. So complexity on the left-hand side, time on the right-hand side. So the longer you go on, you start down the bottom, low complexity, because you're like, how do I buy shares? And you typically start with, in my case, I started with NAB. And then I'm like, oh, if I can buy NAB shares, maybe I can buy speculative resources. And I started to make money from some specky stocks. Like I made 13 times my money in 9 months. And I was like, if it's this easy, I should just do that all the time. And then I went to CFD trading, blew up like $5,000. I think that would have been like a day or two. Came back down the other side. I'm like, you know what? Maybe not CFDs, maybe just warrants. This is about the time I was like,
loves leverage. Now hates leverage.
Yeah, you got the grass comment, and I was like, I'll just buy some warrants in Rio and QBE. Obviously, horrible businesses. Well, Rio's good, but QBE is a dog. And bought warrants, which is leveraged, and then lost money on those. And I'm like, that's it. I'm just going to buy simple shares, and that's when I bought Pro Medicus. And then not long after that,
now you're buying operational leverage.
Apple, ETFs, all of these things. So all of us could probably relate to like some sort of humility curve where you kind of increase complexity. Do you remember what your first investment was ever?
Are you the Carl Richards of finance in Australia?
Nah,
with the charts?
I can't. Well, yeah, stole that idea from David.
It's a very good chart.
Oh, from Tim. Sorry.
My first investment I do remember was shares in Woodside.
Oh, you bought Woodside?
Yeah.
Why is that?
$15 a share at the time, I think.
What's it now?
I'd only been in the industry. I think it was kind of just
26?
leading in. I think it was 2005 or so.
Mm-hmm.
I bought Woodside. I remember it was about $15 something, and 12 years later, it was still the same price.
Mm.
So I started. I think I was just starting to get into the reading financial markets. So read the Fin Review. Oh wow, oil price. Yeah. Oh yeah. Oh Woodside. Yeah. Let's get done. It was easy.
Yeah.
Seemed like it made sense. I reckon I made like 30% within the first 6 months, and then 0 for the next 10 years.
Yeah, it's funny. It's so funny, isn't it? Like, but that's people's experience, right? It comes back to the thing we talked about, like Ben Graham before. If people see things once, they're like, oh, maybe that was a bit of luck. Twice, they're like, oh, maybe it's something here. 3 times, like, I'm a genius. And then that's when mistakes happen. And that's why I've never met an investor that's been in the stock market for like 10 years that isn't very humble, because you can't will a share price to go higher, or as Buffett, and I've quoted him a few times recently, you can't get 9 women pregnant and expect to have a baby in 1 month. It's just, some things take time, So just making sure that you understand that sometimes there's a natural order to things. And long-term investing, if someone's coming out and saying, I'm going to get 15% per year guaranteed, I'm like, oof. It's kind of like private credit. Is private credit making you a bit nervous, or are you okay with it?
Some private credit is making me nervous. I think one of the issues, like when you think about, so what's private credit? It's non-bank lending. It's lending that is done by private institutions that are raising money for investors and then deploying that into individual loans. I think the problem in Australia is that most of private credit is associated with property and commercial property or property development. Yep. That's obviously higher risk and there's big valuation risk. Whereas if you go global private credit, you get this massive diverse array of, you're doing corporate lending, you're lending to industrials, to tech companies, to a whole range of asset classes. So I think it gets a bit lost there. And there's a big thing. I do like private credit generally, I think can be positive, but you have to have transparency. You got to know where your loans are going. You got to know who's on the other side of them, and you got to know what goes wrong when you can't call your loan. Like when your loan gets called, can you get the assets back, or do you have to take ownership?
Yeah, like Metrics did, right, with Rockpool or whatever.
Several, and development sites and all that sort of thing.
Yeah, and that is both the blessing and the curse of being a private invested in private credit. Like the reason that you do it is to have the person that runs the fund could end up running the restaurant because the company can't repay the loan. So that's the downside, I guess.
And that's why knowing what you own is key. Is it secured? Is it senior? What are the valuations? All those sort of things are incredibly important.
We do have some questions here, Drew. I just want to quickly...
We do?
Before we go through, I want to quickly do some things for you. I want to ask you a question on these. I'll just do buy, hold, sell for these names, right? As we go through, you just say buy, hold, or sell, right? Value ETFs.
Buy.
Wesfarmers.
True value ETFs. There's a caveat there, but go ahead.
Wesfarmers.
Hold.
Nvidia.
Buy.
Qantas.
Sell.
Domino's Pizza.
Sell.
That's fallen another 22%? Jesus.
Too many carbs.
Well, fair enough. Woolies.
Buy.
Wesfarmers. Oh, sorry, I said that. WiseTech.
Buy.
CPI data.
I'm thinking about monthly data, sell. Quarterly data, buy.
Yeah, because if you don't know, the CPI data came back stronger than anyone expected, 2.8% for the monthly reading, which isn't always 100% accurate.
Monthly's shocking. Yeah. It's like one thing goes up. Eggs go up, it goes up 2%.
Yeah. So that is a real concern, though, for people, and particularly with I don't know if you saw the news out in the last week. It's not news recently. Oh, yeah, it is news. If you're a first home buyer in Australia, you can use the government's 5% deposit scheme that's coming up from October 1st. And basically the government covers your LMI. Surely the RBA sits back and goes, what are these guys doing over here?
Cowboys doing.
These guys really think this is a good idea? Because then if they're trying to control interest rates, they know that as soon as they put interest rates down again, property prices, they will just go through the roof. And they always say, our job's not to control property prices, but it is the most obvious thing in Australia that has the implication when interest rates fall, property prices go up. It's just totally wild. I cannot believe.
And as soon as you cut that deposit, it just means you can have more demand for a small group of properties.
Well, there's so many bloody things wrong with that policy. I just cannot believe how stupid it is. But just for people that aren't familiar, the government says that you can have a 5% deposit. If you're in Sydney, you can spend up to 1.5 million. If you're in Melbourne now, you can spend 950, which is bizarre. Those two numbers are bizarre as well. And Brisbane, you can spend $1 million. And Perth and Adelaide are similar to Melbourne. So, it's just really just harebrained ideas. They think that it will bring forward 6 years worth of first home buyer demand. 6 years.
And support more development. I guess because we need new homes, not just transferring the same homes.
Well, I guess their theory is that if they just keep pouring fuel onto the fire, sooner or later there will be more stuff to put in the fire.
Another 10 townhouses for you.
Yeah, put that up with some nice cladding on it. Okay, so we've got some time for some quick questions here, Drew. Maybe we'll do a bit of rapid fire, okay? So I'll read the questions out and you just go bang, slam dunk on that. We've got some great questions. If we do answer your questions, they're strictly general in nature. We don't know your needs, goals, or objectives, so don't act on the information until you've spoken to a financial planner, like say Drew. If we do mention things like ETFs or super funds or insurance, they come with a product disclosure statement or PDS, which you can find on the website of that provider. Be sure to read that before you act on any of the information we mention. Final thing is, if you need to find out more about the services that the Rask Group provides, head to rask.com.au/FSG. First question comes from Bullion Stacker. Thoughts on having physical bullion in a portfolio, Drew? I know there are costs such as insurance. However, the bullion section of my portfolio has outperformed every other investment I have, including VGS, VAS, VDHG, apart from my crypto, of course. Drew?
I love it. Love bullion. It's been a fantastic hedge.
You've been legit?
Against portfolios. Yeah.
Okay.
I'm sorry, can you repeat the question?
It's just thoughts on having physical bullion.
Oh, physical bullion. Oh, sorry. Bullion, yes, gold bullion. But in this day and age, I sound old when I say that, we have held physical bullion for our clients, but to buy it on an allocated basis, so you actually see your individual bar. Like if you have 4 ounces of gold, it's like this big.
Yeah,
it's like, then you have to get that made from a larger piece of gold. And the cost of doing that is like 4, 5, 6% of your investment. So you can buy unallocated gold bullion, which we've done before, and you still own part of that pool. It's only that pool that is sold, but you don't have to pay that fabrication fee. So in this, like the way we sit at the moment, you can get a very cost-effective exposure to gold, and you can hedge the currency risk if you wish to. So I love bullion, but I don't love physical bullion. And similarly, it's very difficult to hold physical bullion. Apart from certain instances, and if you want to hold it yourself in a superannuation environment as well.
Good point. Okay.
Thanks for the second attempt at that one.
No, that's good.
I was talking to Chad about my dad jokes.
Illiquidity says, I'm looking at adding some ETFs for active management, but liquidity is a barrier with not much volume available on the market. On my wish list are LHGG, LPGHGD, AQLT, ATEC, MQAE. They say, do you buy LHGG and ATEC on market for Rask Invest portfolios? How do you manage trying to purchase, say, 10K of LHGG when there's only 2K worth on the market? So what this person is missing is that when you buy into an ETF and you see when you log into your brokerage account that there's not many shares trading, that doesn't really matter. And the reason is because when most of the time when you're transacting, and you put an order in the market, you're actually transacting with a market maker. So what you can do is you can wait until just after 10 a.m. in the morning and see if there's any more liquidity show up. But I can see here today, so far, only 9,000 units of the Lakehouse Global Growth Active ETF, or LHGG, which the questioner was referring to, have transacted, which is tiny if you think about it. But if you were to actually dive into it, you will see lots of buyers and sellers either side. And on the other side of that trade is the market maker. So don't overthink that too much. You can jump into your brokerage account during the trading day to observe more trading behavior. We do buy on market for what it's worth. All right, Drew, we've got time.
Noting that is an ETMF, so an exchange traded managed fund.
Yes.
Or an active ETF. It's an ETF.
Yes, active
if
ETF.
It's a listed investment trust or a listed investment company, there's no market maker per se, and you can be trading at a discount or a premium, but an ETMF, so it's got ETF in there, or ETMF, you're all right.
Okay. This is going to, I want to be quick with this one, but I want to summarize their question. Someone wrote in and said, G'day, Owen and Drew, wanting your opinion on a few stocks I'm bullish on. Now, I don't know any of these companies. So Southern Cross Electrical, Vanadium, and Biome Oz. I don't know anything about those three companies, Drew, do you?
I know vanadium. I know it's a rare earth that's important in batteries.
Okay.
So it sounds interesting, but yeah, I don't know enough to probably comment.
So I'll put them to the dome. But what I really wanted to do is summarize their bit at the bottom, which says, P.S. Anyone who has a whinge about someone laughing too much is a bum. In defense of Drew. Love the bands. I'm often laughing along with you guys and your shit jokes. So that was from, actually I didn't get the name of that person read out, but
that's good.
I think it was a great question and a great statement on the end there.
You can have a free book.
Yeah, you can have a free book. Just write into Drew. And so what I'll do is I'll put them to the dome. So we've got Ben. Actually, that question was from Forex Gold Exposure. But what I'll do is I'll put them to Ben and Luke, who are coming into the studio this week. So if you're listening to this podcast and you want to get questions on the show or you want to get stocks reviewed following reporting season, write into us because Luke and Ben are coming into the studio this week.
The speckier, the better.
The more speculative, harebrained, the better. If you can put a little bit of banter on the end there for Ben or for the dome, let us know because I'll lather them with some compliments, but also hit them hard with some good gut punches. So write into us. Use the same link that's in your podcast player in the YouTube description. Just click the one there that says ask a question and Bob's your uncle. So
I was watching this short the other day and it was like, what does SiteMinder do? It's like they're kind of like web beds, but not. I was like, was that there you go.
Yeah, that just stuff.
Yeah,
you know?
just stuff.
Yeah.
Just computer.
Yeah, it's kind of like hybrids, just something.
Yeah.
Now you've got to give us a dad joke, mate.
I do. I had to try a few of these out. I had some really long ones, some short ones. Chad wasn't being very good today. So here we go. Why can't you trust stairs?
Mm-hmm. Why?
They're always up to something. I've had to think about that because I'm like, what if it's a downstairs? Oh, you're up from the bottom. Yeah, all right, I got it.
That's actually pretty good, mate. I'm actually pretty impressed with you with that dad joke. I'll give you a good 8 out of 10 for that. That's a great dad joke.
I'll give Chad the feedback.
Okay, yeah, appreciate it. Yeah. Well, Drew Meredith from Wattle Partners. You can head to wattlepartners.com.au. There's a contact us page there. Put in Drew said it depends on the podcast. If you want financial advice, that gets you to the front of the list. But Drew and the team doing a great job. So get in contact. Otherwise, you can find out more about Rask by heading to rask.com.au. We've got a few things coming up, but importantly, you can jump into the Rask community. That's community.rask.com.au. We're getting about 20 to 25 people joining a day now, which is absolutely fantastic for a free investing community. So jump on board. We'd love to have you in there and send in your questions for next week because the more banter, the better. Keeps us going.
I'll be sending something.
End of reporting season. Share your miseries because it loves comfort and we do too. So Drew, as always, mate, thanks for joining me.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.